Bitcoin has been lagging. What is your prediction, or what are you seeing as the path forward for Bitcoin in Q4? Are you expecting this to catch up with some of the outperformance of the rest of the market? Do you think we see a blow off top? What are you seeing as Bitcoin goes into Q4 here?
Generally, Q4 is seasonally a good period for Bitcoin and crypto. But like seasonality, those seasonality charts are pretty sort of dicey as well in terms of just like trying to look at them as sort of some sort of guide. But generally, Q4 and Q1 are strong for crypto in general. It all really depends on the dollar. The dollar's the massive swing factor here because central banks, although they're cutting in terms of interest rates, which is liquidity positive, but really only at the margin, it doesn't make a massive difference to asset prices. It does to the business cycle, which has a knock-on effect for capital expenditure and consumer spending. So it's generally all very, very positive. But without central banks actually expanding their balance sheets, then really what happens with the dollar is the most important thing right now to track. So I just constantly look at what the DXY is doing. The DXY had one of the largest declines in Q1, Q2, and really into Q3 in decades. And that's the reason why I think even on, the last time I was on the show, John, was one of the main reasons I published like the Bullish Trinity report, at the start of April saying, I think risk assets and crypto are going to go up a lot because of that. The speed of that decline was so significant. Now we're seeing the DXY sort of hold around sort of 90, 98, 99. It really matters. The next leg of that move, whether it's a retest of 101 or a breakdown below, will, I think, be incredibly important for risk assets. My view is that we'll probably test around 100. And so it might be a couple more weeks of chop. But eventually with interest rate cuts and what Trump is trying to do with best interest to try and bring the dollar down, that there is another leg lower. And so at some stage in Q4, maybe in November, we'll start to see crypto start to really catch a bid again. But, there's probably some assets that are worth buying right now with a view to the next sort of 6 months being particularly good.
Gotcha. So you're anticipating, so just to kind of recap this section, global liquidity is still rising. And we've had the Treasury General Account refill, where they, like you mentioned, they extracted about $500 billion of liquidity from the market, which dragged liquidity and dragged crypto. Now that's over or about to end. And so the bull run can continue. And you're saying maybe some more chop, but eventually as we get deeper into Q4, you're expecting this to go higher. I think that's something that a lot of people have been wondering about, and I want to get your thoughts on this too, is now that the Fed has started to cut interest rates, we've got one cut in September, we're expecting to get another one in October, some people are saying even another one before the end of the year. How important is that for crypto markets in your mind? Does that have a big impact on digital assets? Is it going to impact Bitcoin, but not the rest of crypto? How big of a deal is this, or is this already priced in?
I think it's important for financial conditions in the business cycle. So cuts will, supercharge the ISM and bring it back above 50 and sort of, I think, continue or accelerate the improvement on that end. But I don't think it's as important for like just asset prices in general. I think asset prices respond to more of the quantitative policies from central banks. And at the moment, even though it's marginal, the Federal Reserve is still tightening its balance sheet. They're still conducting QT. So I don't expect them to change. Like we don't have a federal a Fed chief that's, I think, going to, while he's in charge, retire that policy. But it's coming to an end at some point. So, whether it's with the new Fed chair next year, if you just look at the way central bank balance sheets have always clipped major turning points in crypto, I think that's more important than interest rate cuts. But that's not to say that they're not important, because the business cycle needs interest rate cuts. Interest rates are too high relative to the economic growth. They need to bring that down. They want to bring that down, interest rates down, so that they can unlock equity in people's primary asset and sort of spur economic growth through the property market. So all of these things are definitely positive for crypto, but it's not, it's not the good old days of the 2010s where it was QE2, 3, QE infinity, and everything just responded on a dime to those quantitative measures. But I think those policies get retired, and also there's probably another trick up their sleeve with adjusting, like the government adjusting the SLR, the supplementary leverage ratio for banks, so they can increase liquidity into the market through more lending. So that would be, that would directly flow into M2.
Gotcha. Yeah, no, it's really helpful insights on that. And I do think that this is something that is really important, what you mentioned. The Fed is continuing their quantitative tightening, even though they are still now starting to cut rates. So there's a lot that you've brought up here that, like I said before, gives a much bigger picture here. Really helpful stuff. I want to move now to a recent report you wrote for Real Vision on smart contract platforms, because I think that there was a lot of great alpha in this, and just like I said, a really institutional grade framework to take to the crypto industry. You highlighted at the start, smart contract platforms have processed $57.8 trillion since 2020, and they're compounding at approximately a 78% annually. What is driving this explosive growth in this, and what do investors need to understand about this huge trend? Because this is enormous amounts of liquidity we're talking about here.
Yeah, so I hadn't done this analysis really since 2022, and the data providers are getting a lot better with capturing settlement volumes. And settlement volumes in the crypto context means they are tracking, settlement flows which are related to peer-to-peer transfers of the native token on an L1, transfers of any other tokens related to that L1. So on Ethereum, it's ERC20, and on Binance, it's their token protocol. So it basically assets moving on chain, but also peer-to-peer transfers of stablecoins and DEX volumes. There's also NFTs, but NFT volumes are really sort of negligible at this point. So you put them all together and you come up with like total settlement volume. The problem at the moment with this data is that even though the data providers are sort of are scaling it up, when you look across chains outside of Ethereum and Solana, you don't have all the data for all those different activity cohorts, but you get a pretty good proxy. So it probably undercounts. Well, it definitely undercounts total settlement volumes, but most of the volume is actually quite concentrated in Ethereum and Solana and also Tron, and there the data is a lot more comprehensive. So you've got a pretty good proxy. Now, the biggest drivers are DEX volumes, actually, which are on Ethereum and also on Solana, account for a large portion of fees. So you could argue, hey, it's just speculative activity. It's degens doing degen stuff. The reason why I did this analysis is that I think it's so important for everyone who's investing in crypto or thinking about investing in crypto, is like, where will we be in the future? So the subjectivity that I experienced when I started working as a crypto research analyst at Bloomberg Intelligence, and you get the sort of sniggly remarks that, this kind of settlement volume is not the same as settlement volume on payment platforms like Visa and MasterCard and PayPal and whatnot. Well, really, what was it showing initially? It was showing that the technology can scale, is far more efficient. The velocity of money that moves inside the crypto economy is magnitudes more than the fiat economy. What is the problem with the fiat economy? Velocity has been declining for decades upon decades, despite the Keynesian economics models and theories saying that they could tweak it through government policy and monetary policy. That has not happened, although we've seen a spike since COVID, but generally that trend has been down. Low or declining monetary velocity in any economy is not good. It shows that capital is not moving. It's not moving into productive use cases. It's not spurring activity and entrepreneurship. In fact, I would argue that the main reason, or one of the reasons that velocity is going down, is because that all new money, or most money, is flowing into investments, not into productive uses, not into the real economy. In Australia, the banks won't give you a small business loan. They'd rather lend against your house in a property market that's like, trading on 16 times median earnings. So this is a huge problem Meanwhile, this parallel system full of degens and libertarians is showing that they can move money, move immense amount of value, and that value that the crypto economy has moved in the last 5 years is almost as much as Visa, MasterCard, and PayPal, but it's growing at 7 to 8 times that in terms of annual growth rates. So within 2 years, it's going to overtake. What happens when Visa, MasterCard, PayPal, which they're already doing, start moving all of their value flows or the settlement volumes onto blockchains? So you get this exponential explosion again. And then the critics can't really argue that it's just degens anymore, because it's actually them paying for their coffee or paying for their Amazon gift card. So it was just really a way to sort of go back to basics. The analysis I was doing in 2022, I was looking at Bitcoin and Ethereum specifically. Now look at the entire layer ones and go, hey, like these guys are growing at a clip, and now all the payment companies are going to actually integrate with them. And that drives the asset price. That drives the value of the L1 token. The L1 token is the settlement token of the chain. And even with new chains coming on that are stablecoin specific, everything is growing the pie. There's going to be winners and losers, but the pie is growing substantially. And we go from, 80 trillion, in 5 years. We do that in like 1 year and 2 or 3 years time is my expectation.
Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.